Hello, everyone, and welcome to another episode of Let's Talk Business South Carolina. We are up to episode number 70 if you are keeping score, and as always, I am your host, Rick Jenkins. It is time for another industry outlook, and today we're diving into the banking and lending outlook for 2026. Interest rates, access to capital, and economic uncertainty continue to shape how businesses make decisions across South Carolina. From lending conditions and credit availability to investment trends and regional growth, today's financial landscape is anything but static. Here to help me with the conversation is Bart Willey. Bart is the market president at Truliant Federal Credit Union. But before I get to Bart, I do want to thank our presenting partner, Haynesworth Sinclair Boyd. They're one of the premier law firms in the Carolinas. With more than 135 years of experience, they are a full-service law firm serving clients across the Carolinas and beyond. The firm has more than 120 attorneys working from 5 offices in Charleston, Columbia, Florence, and Greenville, right here in South Carolina, as well as Raleigh, North Carolina. The firm represents clients across a wide range of industries, including healthcare, financial services, construction, manufacturing, government, and real estate, among others. Practice areas encompass a wide range of areas, including business litigation and corporate law, as well as employment, environmental, healthcare, intellectual property, tax, and regulatory matters. Thanks again to Haynesworth Sinclair Boyd for helping to make it possible to bring this content to the business community in South Carolina. And now, here to help us understand the financial trends business leaders should be watching in the months ahead is Bart Willey. He is the Upstate Market President at Truliant Federal Credit Union. Bart, welcome to the show.
Thank you, sir.
Welcome back to the show.
Yes, sir. We've done this a few times now.
Yes, we have. And I tell you what, you were here last year at about this time, and we were having this conversation. And, you know, when the conversation, when we were talking last year at this time, we were talking tariffs. We're still going to talk tariffs again, folks. But last year at this time, it was just beginning. People did not know what to expect. I think in a lot of ways, we still don't know exactly what to expect. But we're going to talk about that here in just a bit. But I tell you what, Bart, before we head down the road of 2026, I want to take a look back at 2025 and sum up the year for us from a market perspective, a financial perspective, a banking and lending perspective. Tell us.
Absolutely. So I told you earlier on that I am going to be very on brand today.
Okay.
So I skipped the jacket so I could put that sunburst right on.
Sunburst for Truliant, and you're going to be all sunshine.
I am all sunshine.
That means you are bullish about what's happening.
I am bullish, and I'm bullish for a lot of reasons. And I brought the as they say, I brought the receipts because
Very good.
Last year we talked about tariffs, and we actually caused a little bit of controversy, which was fun because none of us knew where it was going. And like you said, it changed day to day, and we still don't really know in some cases. I mean,
Right.
We won't even go into what's happening today because it might change tomorrow.
That's right.
But bullish for a reason. So let me start out with a few basic things. When you look back at 2025, you're really talking about the tale of two halves. It's two halves in many ways. You look at the way 2025 started, inflation was still raging. People's income was going up slower than their housing costs. They felt like every month they got their paycheck, they were a little bit poorer each step of the way. By the end of the year, it has flipped. Now, it doesn't feel like it's flipped for most people yet, but the truth is one of the key drivers, even though inflation has come down, it's come down at a steady pace throughout the year, still higher than any of us want. But one of the drivers is wage inflation.
That's right.
So if you don't have a job, that doesn't mean anything to you. But if you're in the aggregate, wage inflation is actually one of the highest drivers of inflation right now. Well, that's something we like. When your wage inflation is higher than your housing and rent and other types of inflation, then you're going to start making progress. So when we started the year, if you average out the year 2025, because we're looking back, it would look like a marginal year. But if you look at Q4, if you look at Q4, and this is what I want to talk about is Q4, because that tells us why I'm so bullish about 2026. In Q4, we had productivity growth. People don't talk about that very much. Why is wage inflation possible? Well, it's because we have massive productivity growth. Productivity growth in the fourth quarter was listed at 4.9%. Well, if each individual, whether it's through automation, AI, robots, whatever the case may be, if productivity is growing that fast, then people can get paid more because each one of us is helping produce a little bit more of our product or our service, and we're being more productive and helping out our country. So when you look at that, then you get the Fed, the Atlanta Fed just announced the other day that they're estimating fourth quarter GDP to be well in excess of 5%. When you take the largest economy on earth and it grows in a quarter over 5%, if that turns out to be true, that is not just good, it is fantastic and it's amazing.
Well, I would say that if that were the case, that would be fantastic. But I'm going to tell you what I feel. Okay. I feel like we are in at a time of significant economic uncertainty. I still think that the status of tariffs, which is up and down because we never know exactly what's going to happen with it, right? I feel there is wage stagnation. I know there is unemployment issues. We're about 4.3, 4.4%, which is about middle of the pack in the United States. Even though South Carolina a few years back was humming along nicely, but we're dealing with that. We're having layoffs in South Carolina. Manufacturers are pausing because of tariff circumstances just to kind of get the lay of the land, and they've been pausing for months and months and months. This is what I feel. Tell me why I'm wrong.
You're not wrong. Feeling uncertainty when there's this much change in an economy makes all of us feel anxious. Certainty makes us feel good. Whether it's rising certainty or whether even in a slight decline, if it can be managed in a slow way, we feel good. And if you don't have a job, like I said, it doesn't matter how good the economy is, your personal situation is in flux. Or if you feel like AI could change what's happening. So I'm going to give a quick shout out because it does play into positivity. And then what can we, what can employers do? What can a credit union do to help in this situation? So we ended 2025, we set a record. It was our best financial year as a financial institution in our history in over 75 years.
Well, no wonder you're all sunshine today.
Absolutely. And we're expecting to do this going into 2026. Yep. And the way that we turn around and we help that situation, so our members, we have a lot of members that are blue collar. That's who we are. Low to moderate income, blue collar people. That's who we're helping. So what we did, and we're going to touch on AI, but we use AI later when we talk about it, so that we can do things to help people beyond credit score, so that we can help them get the cars they need, especially in tough times. We've come out with a 5-in-1 mortgage that has just taken off. It's right now starting at 5.25%. Well, 30-year mortgage rates have come down from the 7s, but they're still in the 6s. And so that hurts. So if you're a middle income, blue collar, even upper middle income person, with the way housing prices have inflated over the last 2 or 3 years, you feel like you fell way behind. So, being able to get a mortgage at 5.25%, we did well. We are a mission-driven, not-for-profit. So we say we're people helping people. So what can we do? And we set up a mortgage at 5.25%. That's makes a huge difference in housing affordability, especially for first-time home buyers. We also did what we call a drive-down program. Car inflation was massive. People had to get cars the last 2 or 3 years. And we've been lowering those car rates as fast as we can to help people get better payments, make their lives easier. So transactionally, individual situations are in tough places. And so that's how we give back. And we can go into what we call lending deeper into the community.
Bart, please tell me we're not going to have a 50-year mortgage.
I certainly hope not.
Okay. That makes no sense.
That when you do the math on it, the difference is insignificant, unless you're talking about multi-million-dollar homes.
Well, yeah, but it just seems to me that if a person gets a 50-year mortgage on a home, they have to stay there a long time to build any equity whatsoever, and you're going to be upside down in your home for a long time. That's the way I look at it.
Right.
And so if you move in 6 or 7 years, you're going to lose. But anyway, I don't think that's going to happen. Let's talk about. Tell me what type of indicators you look at, financial indicators that tell you whether to be bullish or not. And I mean, I'm talking things like consumer spending, unemployment rates, which we've already talked about. How about business investment? Who's investing? Who's spending? Looking for capital and that kind of thing. What do you look at?
So one of the places we go to, the first place we go to is we look at our member base. We look at, how are their deposits? How are their, deposit accounts operating? And what we're seeing stability. So that doesn't mean that people feel great. It doesn't mean that it's growing rapidly, but it does mean stability. So when the entire economy is growing, and we can talk about this as well, we are so blessed. I told you I was the ray of sunshine. When you look at where the country is going, and then you look at the fact that the upstate of South Carolina has one of the highest, it matches that growth rate, but it's the highest inflow of people. It's a blessing and a curse at the same time. So we'll touch on affordable housing and the need for that as well. But what I look for is I've had a chance to talk to a lot of the largest commercial real estate groups in the upstate. And I've asked them, how has the year started? What are they looking at? Their deal volume is growing. Their interest is picking up. Leases are picking up. So we're seeing the activity, even though we may not feel it individually, and certain groups, if they're in a transitional industry, may not feel it. We have so many major plants, so many groups of manufacturers, whether it's in the biohealth side or whether it's advanced manufacturing, that are growing in this area. A statistic that's fascinating is of those very large industrial buildings that were built in Greenville County and Spartanburg County, all of them are full in Greenville County now, and they're rapidly, continually filling up in Spartanburg County. So across the upstate, we have so much industry moving here because of our industrial base, because of our people, and the number of people coming here that I can't help but feel bullish.
Right. The Feds, Bart, let's switch gears a little bit. Federal Reserve cut rates 3 times in 2025, and it appears there'll probably be another cut on the horizon before too long. Look into your crystal ball and tell me what's going to happen in 2026. Couple cuts or what?
So one of the questions always comes in is if inflation were to pick up, it would slow down their rate of cutting.
Right.
Okay. And then I would say that, when you have high GDP growth, people might think, well, you're going to have an uptick in inflation. But I also said one of the offsets to that rapid growth was productivity growth. So I still remain confident that we're going to have at least 2 cuts this year. Last year, I would say that we predicted internally, we were thinking there would be 2 cuts. There were eventually 3. I do believe that the cuts may speed up as the year moves along, especially if there continues to be a little bit of slippage in inflation. I think that will happen. One of the things that doesn't get discussed a lot is the drop in the prime rate. When the Feds drop the prime rate, their lending rate and the prime rate that goes with it, is that impacts and helps our people, the middle class and lower middle class, even more, because it helps them with their credit cards, with their home equity lines. Those immediately start to reprice lower. And in many cases, credit cards as well. So that also makes me feel bullish, that I feel that the downward trend is at least 2, maybe 3 more cuts this in 2026.
Are you seeing people change ways that they might structure debt? For example, are people seeking out fixed versus variable rates? Are they going 30-year instead of 15-year or more? Are there alternatives that you are seeing pop up now that don't normally pop up? Alternative financing.
So there is alternative financing out there. Lowering rates actually brings a lot more people back into the traditional banking system. instead of going to other sources of lending. And I would tell you, it's not that it's, there are people asking for the 30-year mortgages on commercial properties. So that is an ask, but that's really more of a cash flow play right now than it is anything else.
What is, I've never thought about that before in terms of business lending on commercial properties. What percent of the pie is traditionally a 30-year or a 15-year? I would have no idea. What is that?
And I don't know that number off the top of my head. I would tell you that traditionally, banks have been more comfortable in the 15 and 20-year range. But you also look at the quality of buildings and construction and how long buildings last. Then 25 and 30 years makes more sense in many cases. We're very blessed not to have a large stable of old buildings in similar, I'm referencing more of a downtown San Francisco, New York, Chicago, things of that nature. We have a lot of good quality new buildings that you can lend on. Their lifespan, their useful life will extend at least 30 years.
Or which sectors are performing well and which may be underperforming to some degree? I mean, manufacturing, as I mentioned earlier, is struggling a little bit, and I'm not saying, completely across the board, and I don't want to paint with a wide brush, right? Okay, but we're seeing layoffs at some of the large manufacturers in South Carolina. And as I mentioned before, a lot of folks just pausing in that industry. Other sectors, what are you saying?
So it goes back to disruption.
Yeah.
This almost feels like, I'm going to use a real old thought, the horse and buggy transition to the car. It really feels like we are in something so significant that it is about that level. When you think about the AI and how it's going to impact manufacturing, it really impacts manufacturing, the robotics that are going to impact manufacturing. So I think that what's happening is, and you always get creative destruction whenever there is change in technology and what people want. So yeah, there are layoffs, but you also have to remember that at the same time that there are the layoffs in some places where they're gaining efficiencies, here we're growing so quickly that what our obligation in the Upstate as an Upstate group is to help those people reskill so that they can move over, into those other industries that have moved this way, that are opening up. We have all these great things from aerospace to the advanced car manufacturing, but there's so much more that's happening here. So what we want to do is we want to help people upskill, reskill, so that they don't have a long period of unemployment, or they don't become unemployable. And so we're very blessed. They're actually, our technical colleges, I've touted on that since day one, the very first time we ever met. They are doing an excellent job of helping people make those transitions so that when one industry is having a challenge, and I really want to make this point as well, because it's disruption. So a lot of what's happening is the supply, going back to tariffs, how they're impacting supply chains. And we have an enormous blessing that I don't think gets touted enough in the traditional news sense. We have the inland port. With onshoring, when things are going to be built here and exported, and then the things that we need that are still going to be imported, the inland port has an enormous impact. That is such a blessing. And it puts us right here on this 85 manufacturing corridor that goes, all the way from Raleigh to Atlanta. We are sitting in the perfect position. And I think that's what's really bringing people here is quality of life, the workforce development. And then, as they say in commercial real estate or regular real estate, residential, location, location, location. So it's still shining, and I'm still positive.
Bart, a couple more things, and I'm going to get you out of here. Real quick, give me the biggest risk, potential risk in 2026 that we need to keep an eye out for.
That is such an excellent question. And it's a little more complex than we can get into here. I'd say keep an eye on the treasuries and growth. as long as the GDP growth continues on that upward trajectory, I got to get more words out, and the demand, the treasury demand stays even, then I think we're in great shape. I think a lot of good things are already in place.
Best opportunity that we could hope for coming in 2026?
You can't live in fear. I think taking all that transition, all that concern, but I think if you don't get out there and take part in the growth of the upstate, then you're going to miss out on one of the greatest opportunities that we've had in a very long time. We are set up with the people moving in, with the businesses moving in, with the technology changes, that we just need to help our people in the upstate. Like I said, reskill, upskill, and move into all those new great jobs that are coming to the upstate.
Bart, good stuff. Mr. Sunshine today.
Thanks, sir.
Great, really smart guy right here, guys. And he, like you said, he's all sunshine today, feeling good and bullish about 2026. Folks, I do want to thank one more time one of our presenting partners, Hainsworth Sinclair Boyd, one of the premier law firms in the Carolinas, for helping to make it possible to bring this content to the good folks of South Carolina. Folks, that's it. That completes another episode of Let's Talk Business South Carolina. We'll see you next time.